Test, test. Okay, that should be good now. Testing, testing. All right, that should be working now. Sorry, guys who are on live stream there. Okay, yeah. All right. Apologies. We're just going over the labor market right now. So going back to job openings, as you can see, um, in the construction sector, it hasn't been this bad since the 2008 Great Financial Crisis. It's even below the trough of the pandemic crash. And so, when these leading economic factors are signaling this depreciation here, this is clearly showing that there's some pain ahead. Typically, construction and manufacturing job openings, uh, they they are leading the economy by about 6 to 8 months. Which puts us historically around like August. Not saying that's when a recession is going to occur, but you can't ignore these leading indicators here. And so that's what I was noticing this week from there. The US non manufacturing PMI, so this is for services, that continues its decline. It's still in expansionary territory, but it is weakening on a 4 month trend basis. And so, really, the services sector is a area of the economy that's very lagging, and typically it doesn't start to feel a lot of the pain until we're already late in the cycle. Sometimes when we're even heading out of a recession. And so, now that we're starting to see the services sector go back into a downtrend, again, it's still expanding, but not in contraction. We really want to be able to pay attention to this. We also got the ADP non-farm payrolls, which accelerated, and so it's continuing to showcase that the labor market really is in some type of freeze right now. What's interesting is that when looking at large versus small and medium businesses, um, small establishments, so employees ranging from 20 to 49 employees or less than that, that remains in negative territory, which makes sense, right? Usually, when there's high interest rates and high inflation, typically the smaller businesses end up getting hurt the most. And then what's interesting is that very large establishments, so 500 employees or more, that continues to accelerate. And so it makes sense because a lot of these businesses are very cash heavy, as well as they're being supported. But it's interesting that typically the small businesses lead declines in employees for these large businesses, but you had a divergence around March of last year. And so this is atypical, but you do want to keep that in mind because we are starting to see a little bit of a slowdown in these large establishments. So that's what I was looking at on Wednesday. On Thursday, we got the Challenger job cuts report, which improved. That declined negative 40% year over year compared to January of last year, which means that job cuts are declining severely, which is technically a good indicator. But that's typically saying that, the amount of jobs being cut, employers are not hiring, but they're also not firing. And so it's adding to the narrative of the job freeze. And then on Friday, we got the private non farm payrolls report for the establishment survey, as well as the household survey. And that had a slight acceleration. And so this is showing that we're not in a huge deterioration in terms of the establishment survey. And so just to go back to what these two reports are saying, the establishment survey actually, surveys a lot of the different businesses that are out there. And then the household survey is just, different households participating in the survey itself. And so some people say that the establishment is more credible than the household, but really you just want to see what the two are saying in comparison to each other. And so if they're diverging, if they're saying the same thing, if they're saying the opposite, that's what you have to look for. And so we're seeing an expansion in the establishment survey, as well as a large improvement in the household survey. And we talked about it a little bit last week, how there was a large acceleration in a lot of foreign-born job increasing. So this could change with a lot of the policies from the current administration, how they're cracking down on a lot of those different illegal immigrants who have a lot of the labor market jobs. So, this is a large 2-month acceleration, which we'll keep an eye on, as well as the unemployment rate decreased to 4.0% from 4.1, which is an improvement. And this is backing what the Fed was saying is that the jobs market is staying solid. It's not getting worse, but it's also not getting better. Now, when looking at the Atlanta Fed has a really good chart that shows updates with the labor market, namely this one here, which is the labor market demand versus supply curve. And so typically when it's in the red, that means demand is exceeding supply, which you are seeing it right now, although it has narrowed a lot. And then in the green, that means supply is exceeding demand. That's typically happening when the labor market is deteriorating at a faster pace. And so we're not quite seeing that right now. But if this does go into where supply is exceeding demand, that's something to pay attention. Typically, when this narrows and crosses, that's when you want to pay attention there. What's interesting is that when you break this down in terms of wages for the different sectors, you can see that the worst are in things like mining, manufacturing, as well as retail, whereas the most gains are in professional business services, healthcare, as well as transportation, as well as government as well. But the most was in healthcare. And that's interesting because, when you take a look at the healthcare sector, XLV, which we'll go to a chart soon here, you can see that it's been having a large rebound. One other thing that I like to look for is the Atlanta Fed's labor market distribution spider chart, which shows a year-over-year change of the different types of pockets of the labor market, namely employer behavior, confidence, utilization, and flows. And so this outer ring is what's considered full employment. And then as you go to these inner rings, that shows less full employment. So you can think of if these different measurements are near the outside of the ring, that's a healthy or a very strong job market. But if these measurements are towards the inside, that's a weak labor market. And so as you can see, this is the green mark here is 2024, so last year, and then the orange mark here is 2025. And so as you can see in certain parts, it's expanding or it's accelerating, and then mostly it is declining compared to last year. And so the big thing is private hires. So the hiring rate has completely collapsed. And so see how it's going towards this inner circle? That means that this part of the economy is suffering a lot. So hiring rate has collapsed a lot, as well as when you take a look at wages have declined a little bit, the unemployment rate, as well as the quits rate, those have declined. And then we see that payroll has actually increased compared to last year. And so that's what's contributing to when the Fed says if you have a job, it's good. If you don't have a job, it's bad. It's showing that the labor market is freeze. And I think we've beaten that dead horse pretty much. Okay. And then looking at investor sentiment, we saw that there was a rebound last week, but then it went right back down to neutrality. So I saw that a lot of headlines and people were saying how the market is net bearish. But when taking a look at sentiment, it is a little bit less than neutral right now. And so I wouldn't say that investors are incredibly bearish. They're mostly cautious. And so for the title of this video, we said, should you sell? Should you go into cash? The answer is no, because there's other sectors that are performing well. But what is interesting is that when you take a look at insiders selling versus buying, so this is company insiders versus selling and buying, you can see that the amount of selling versus buying is at a very high ratio, signaling that, a lot of insiders are preparing for a little bit of a weakening equity market. But sometimes, as you can go back on this chart, that it might have been premature. So you can't use this in and of itself. I saw on Twitter or on X that, the insider selling versus buying ratio was causing some panic, but this in and of itself isn't an indicator, to look at by itself. But it is notable that there's a lot of insider selling versus buying. And so for this week, we have inflation. That comes out on Wednesday. We always want to look at the year over year number. We have PPI, which is producer prices. That typically leads CPI, and that comes out on Thursday. And then on Friday, we have retail sales, which is a large component of consumption, which makes up 70% of the GDP number. So retail sales is something that you want to track, and that comes out on Friday. Taking a look at the inflation expectations, going back to Atlanta Fed, we can take a look at the different measurements of inflation. There's a lot of different buckets here, but compared to last year, this is for the December print, you can see that there's still improvements happening. So compared to 2023, inflation has been improving. What I want to highlight here is this market-based core PCE, which is something that is new, being highlighted by Jerome Powell at the Fed. During the January FOMC press conference, he was highlighting this specifically. And it's funny because if you go back to the different meetings, he typically highlights different measurements. In one meeting, he'll talk about sticky CPI. Another one, he'll talk about headline. Another, he'll take a look at, core or super core. Well, now he's talking about market-based core PCE, which if you take a look at a chart of that, let me just zoom in here a little bit. We can see that that's currently at 2.4%, which is pretty close to their 2% goal. But when you take a look at what this chart looks like compared to pre-pandemic levels, the upper bound was around 2 or 1.7%, and the lower bound was around 1%. And so this 2.4% is still higher than the pre-pandemic average. But this is now what they're choosing to focus on, which has remained flat pretty much since April of 2024. And so if this continues to decline, that would be considered an improvement with inflation. So inflation coming down. But we'll just have to pay attention there. If we look at the Cleveland Fed's forecast of this, we have inflation, headline inflation, coming down to 2.85%, which is in line with expectations, as well as core PCE coming down from 2.8 to 2.5%. And so an initial reaction from CPI, if we see that it comes down, especially with the way that the markets have been on a decline as of lately, this could be a positive catalyst because, again, if inflation is coming down, that means it's getting closer to the Fed's 2% goal, and the market could see that as a positive and have a price jump on that reaction there. The problem is that we're seeing growth starting to decline as well. And so typically when you have the year-over-year rate of change of both growth and inflation declining with a stagnant labor market, that could be a little bit of a troubling environment for things like growth stocks, specifically tech, which we've seen so far. And so we have to pay attention to see if both inflation and growth are decelerating at the same time. That could be a little bit of trouble there. And so in terms of growth, when looking at the Atlanta Fed's GDP nowcast, we saw a large decline this past week, namely from the labor market sector, as well as private gross domestic investment. And so at the beginning of the month, that was around 3.9%, which is fairly large, but that came down a full percentage point to 2.9%, which is more in line with what we were thinking beforehand. Now, this all comes at a time where the financial conditions are very loose. So despite interest rates being high, financial conditions themselves are very loose, which makes sense why we're seeing things like XLV, the financial sector index, in a bullish trend right now. It's one of the best performing assets. When this starts to accelerate, that typically signals a tightening in financial conditions, and the market does not like that. Similar to what we saw back in 2022 when this was rising. And so financial conditions remain loose. Bank credit remains flat. And so an accelerating bank credit is typically favorable for equity prices. And so with it remaining flat here and not accelerating, this is the year-over-year rate of change in bank credit. This is also causing some headwinds in the market. Taking a look at 30-year fixed mortgages, the 10-year U.S. government bond yield has been coming off of the top end of the range, so it's no surprise that the 30-year fixed mortgages are also declining, but that remains relatively high at 6.89%. Let's see if we go back to the 10-year average. Yeah, so 30-year fixed mortgages are still, a lot higher than the pre-pandemic levels. Let's go to all real quick. Yeah, so as you can see, the pre-pandemic levels was around, 4%, 3%, and they're more than double right now, which is putting a lot of pressure on the housing market, as we know. The CRB commodity index, that remains elevated, but has come down a decent amount, which is positive for the inflation metrics. Lastly, we'll take a look at the target rate probabilities for the Fed meeting in March. That remains at a 92% chance of a pause. Now, if we see that the inflation number comes down more than expected, then we could see a higher probability of them cutting in March. But as of right now, there's a heavily weighted probability that they continue their pausing that's happening right now. And so going over to the charts here, let me just bring up, I have some notes here. The first thing that I want to bring up is the dollar. So 1 second here. All right, so taking a look at the dollar, yes, it has come down from its peak in mid-January, and the market has liked that. Typically, a weak dollar signals that there is a little bit more of growth performing well. But we can see that it still has remained resilient at this lower bound at 108 for the DXY index. We do remain long the dollar, but we don't have it as a tradable action right now. Oh, Zoom screen not showing. There we go. Appreciate that. Yeah, and so the dollar remains in bullish trend. We also have gold. So gold's something that we've been tracking. Gold has been having a large acceleration, which typically when gold makes a move like this, it is signaling a trend shift. And so as you can see, gold was on a pretty decent run up throughout 2024. And then around October, when this started to decelerate, that's when we had a large acceleration in things like Tesla and Bitcoin. That it started to take a break, but then gold started to reaccelerate here. That in conjunction with the 10-year U.S. government bond yield having a deceleration, as well as oil prices decelerating, this is signaling to me, to our team, that global demand, so global growth, is coming down. And then there's also a flight to safety. So a lot of the different risks that are happening right now, that's the reason why gold is accelerating. And this could signal that there's more of a risk-off environment, but that doesn't mean that you just sell everything, go into cash and buy gold, because there's certain pockets of the economy that are still performing even better than gold, as well as the majority of the markets, specifically with the financial sector. Let me just bring it up here. All right, so if you look at financials, this has been the best performing sector in the S&P 500, and it closed at new all-time highs last week. That is typically showing that there is part of the market that might be expecting rate cuts pretty soon. Obviously, the financial sector does well when the Fed is cutting interest rates and those are falling. And so if we're seeing growth is declining, there is a little bit of anticipation of rate cuts falling. We could also see the yield curve start to steepen because of this, but it would be signaling that there could be more recession risks going forward later in the year. Again, this isn't to say that a recession is actually going to happen. That's just showing what the market is saying right now. But what also is interesting is that we're seeing the healthcare sector having a rebound, as well as communications remain one of the top sectors that are performing well right now. And so, with oil down as well as the retail sector down, home builders, that is demand falling, slowing growth. And so this could be a reaction to a more stagflationary environment. We'll start to see more once we get the CPI number this week, because if the inflation number remains relatively flat, that would definitely imply that we are in a more of a stagflationary environment. And so also as well, when looking at central bank liquidity, this remains near flat as well. We've been talking about central bank liquidity for quite some time. And I saw that on Twitter, there was a lot of people talking about the decline in the reverse repo facility, which we've been talking about for a while now. But a lot of people were shouting that this is completely drained. We're about to have a liquidity crisis, blah blah blah. But the only thing is that when it comes to liquidity, you still have an ample amount in the Treasury General account. And so there's a little over $800 billion in the Treasury General account, which can be used by the government. So you can think of this as the cash balance by the US government that's held at the Fed. And so when this starts draining or declining, that is liquidity being injected into the markets. And there's still a lot of that left over there. So don't panic just because the RRP is getting or is a lot lower than before. I don't think that there's going to be a liquidity crisis anytime soon, at least for the next several months. And then the Fed continues to do their quantitative tightening by reducing assets off their balance sheet. So what we can also take a look at is Bitcoin. So, Bitcoin has been struggling a little bit here. And in my video yesterday, we talked about how some of the momentum indicators on the longer term time frame have been signaling that there could be some pressure, with Bitcoin. It's certainly lost a lot of trend strength, as well as altcoins have been having a very tough time. Specific ones, such as XRP and others, have been doing well, which we'll talk about here in a second offline for our members only. But the main concern that I have with Bitcoin is when taking a look at flows. So there's this one website that I like to look at called the Bold Report, which I would definitely recommend for those who don't follow the Bold Report. It's a free website and it shows cumulative flows. And when taking a look at the 90-day change, and if I just zoom out here a little bit, if we go back all the way to where Bitcoin topped in late March of 2024, when it hit 73,000, that was when the rate of change of 90-day Bitcoin ETF inflows was starting to trend lower. And so if this starts to decline at a faster rate, right, we're already seeing that right now. If we zoom in what's happening, then that's going to be continued added pressure to the price of Bitcoin itself. And so we could either continue to see Bitcoin go sideways from here or continue downward if this does not reverse. And then if you take a look at 30-day change in Bitcoin ETFs, you can see that it's putting in a lower high. And then 7-day, it was accelerating from where it bottomed on December 24th, which did boost the price. But as you can see right now, this past week, it has declined a bunch. And so in this ETF environment, this is something where it's not like before in previous cycles where you didn't have this much institutional interest in Bitcoin. And now that we have these spot ETFs, you have to be looking at the flows. And so the saying that we like to say with Bitcoin is that the flows always knows. And so with the weakening right now in the ETF flows, I'm not surprised that Bitcoin's price has been stagnant for the better half of about 2 months. Not to say that I'm bearish on it. Our model is still bullish, but it has lost a significant amount of trend strength, momentum. And so when something like Bitcoin is not as strong, right? It's still strong, but not as strong, as well as we have gold accelerating, oil falling, as well as a hyper concentration into a certain sector in the economy. You have to be paying attention there because that is signaling a trend shift. Not to say just go all into US dollars and ignore everything. That's not what I'm saying. It's just you have to be diligent on what you're invested in. And this is really a great environment for traders. People who are long-term investors, this becomes a little bit of a challenge. And so from here, we have to just see how the data improves. So I think that as of right now, we're going to be highly dependent on a lot of the headlines that come out, unfortunately. There's a lot of uncertainty with the effect of tariffs from the current administration applying those. And so, yeah, that's pretty much the environment that we're in right now. And so in summary, the best performing assets, gold, financials, as well as momentum. The worst ones are energy, oil, retail, as well as home builders. Also, one thing that I forgot to mention, or two things, is the Bank of Japan is raising their interest rates, and so you're starting to see this increase in the Japanese yen when compared to the dollar. And this is also signaling that growth might be slowing in the United States as well when you start to see the Japanese yen accelerating compared to the dollar. And then two, as we know, the market is highly concentrated into a select amount of tech stocks, these mega caps: Apple, Nvidia, Microsoft, Amazon, Google, Meta, and Tesla. As we've shown, the amount of these mega caps have shifted trend. And out of the 7, only Amazon and Meta remain in bullish trend. Meta has the best or the strongest momentum right now. And so Amazon had a decent correction from its earnings, which I was actually buying some around this level, around 230 last week. We'll see what happens. It still remains in bullish trend, and so I took advantage of the decline there. And we were also talking about raising cash into the earnings report, which turned out to be good. And so I was buying some there. But you have to be paying attention because Tesla, we have Tesla as bearish now. So it broke through its 380 and it closed around 360. So that joined Nvidia, Microsoft, and Apple in terms of bearish trend. And then Google went neutral in our model, which was formerly bullish. So the trend changes were both in Tesla and Google, going from bullish trend to neutral or bearish. And so when we're seeing when we only have 2 out of the 7 mega cap stocks that are now in bullish trend, that is also showing a larger trend shift. And the risk there is that it's not just the United States that's invested into these mega cap tech stocks. This is global. So when you talk about global exposure, these 7 mega cap tech stocks are very important. And what was interesting was that if interest rates continue to fall, a lot of these mega cap tech stocks were performing well when interest rates were rising because on their balance sheets, they were cash heavy. And so if they continue to be cash heavy and interest rates are falling, then they wouldn't be gaining as much from their cash balances, and that could actually have an impact on their share buybacks. Because a lot of these companies have been propped up with a lot of their share buybacks, and if they are no longer cash heavy and they can no longer do that, then you could get into a situation where lowering interest rates could actually be a headwind for a lot of these large mega cap tech stocks, which we've seen have remained flat and are now bearish. So that's what I'm looking at here. And one thing that I like to showcase is that in this environment right now that we're in, we talk about this every single Sunday macro wrap up, but it's always good to talk about it, which is that we are in an environment now where there's more inflation, there's higher than average inflation, as well as higher than average interest rates. And so it's a lot different than this more of an easier cycle from the past 30 years where the average inflation rate was low, as well as the average interest rate was also low. And so in doing that, you have to make sure that you're paying attention more towards the macro, as well as being a little bit more diligent with the way that you're positioned in the markets. And so that's why we created this community, Macro Optics, in order to help people learn this stuff, but also make sure that you're implementing a sound risk management process. And so for those who are joining us live on the stream, if you guys are interested in learning more how to incorporate macroeconomics into your investing process, you can just go to the link in my bio. We have a free 7-day trial going on right now. And so if you guys want access to that, you can have the link there. But from here, we're going to go ahead and end the public stream and go to our members who are on the call right now and go into the different single stocks, as well as some of the things that I'm looking at trying to invest in here in the week coming up. And so again, if you guys who are joining us live want to join the call, just start your free trial using the link in my bio. But that concludes the live stream part of the Sunday macro wrap up. So I hope you guys have a fantastic rest of your Sunday. Go Birds. I have my AJ Brown jersey